Hello to all the amazing traders of prime risk. It's time to make a big change in the trading world. Today, you're going to learn the main secrets and hidden tricks of working with liquidity, and you'll be able to use it to achieve consistent profits. You'll learn about liquidity in the simplest way possible, and I'll also teach you a strategy with an amazing win rate that you'll enjoy. If it's your first time visiting our channel, don't forget to hit the subscribe button. We're going to learn about liquidity in the simplest way, so let's get straight to the point. Why does liquidity happen? When the price is within a support or resistance range, there's always a lot of liquidity above and below these levels. The reason is the stop losses placed behind these levels. For example, when the price creates a resistance zone, it's natural for traders to look for sell positions at the top of this range. Those who want to enter a sell position here place their stop losses above this resistance zone. These stop losses create liquidity, and one of the reasons the market tends to attack liquidity is precisely because of this liquidity. To make this easier to understand, I'll use the term hunt. Imagine a trader who enters a sell position here and places their stop loss just above. Now, this trader's stop loss is like prey for the market, and the price moves toward this liquidity to hunt it. After the price hits this liquidity level, we usually see a sharp move. The reason for this is that the market's orders are filled with these hunted stop losses. Often, in these liquidity zones, you can see candlestick patterns like pin bars with relatively long shadows. This is what we call a liquidity hunt. The same thing happens when a support level is created. Behind this level, liquidity forms again as buyers place their stops below it, and they are hunted by liquidity just like the previous explanation. Liquidity hunt strategy. Step 1. First, you need to identify the market trend. Why do I say identifying the trend is the first step? Because knowing which part of the market cycle we're in significantly increases your chances of success. You need to determine whether the market is in an uptrend, downtrend, or trading range on the 1-hour time frame. Step 2. Next, draw the support and resistance zones. These are the levels where liquidity forms, and the market often moves towards these levels to fill orders. For example, when the price is in a trading range, you need to draw the upper and lower boundaries and prepare for a liquidity hunt. When the price breaks these levels, a liquidity hunt occurs. In other trading methods, traders often try to enter positions directly at these levels. For example, they might enter a buy position when the price reaches a support zone, and in most cases, their stop losses get hit. This is exactly why we learn this strategy, to avoid entering trades solely based on support and resistance levels. The price will break this support level downward, and the first sign of a liquidity hunt happens. Step 3. Next, wait for the price to create a higher high, also known as a BOS or break of structure. After the liquidity hunt, the price moves up and breaks the previous high. At this point, the price has filled the stop losses of those who entered trades near lower levels and is ready to move higher, but it needs to complete its orders first. That's why it retraces downward to a demand zone and prepares to move up. This is where we enter our position. For example, when the price is moving downward, opposing colored candles that form fresh FVGs, fair value gaps, or order block levels can be excellent entry points for us. We can enter at these zones and place the stop loss either behind this zone or behind the liquidity area. For setting targets, we can consider the upper liquidity zones as potential targets. Let's go to the chart to see a practical example. And remember, if you enjoyed this content, a small like gives us great motivation to create better and more content. As we can see, the price is in a trading range. First, we mark the upper and lower boundaries, and below these zones is our liquidity area. We wait for the price to reach this level and hunt the liquidity. Now that the liquidity has been hunted, we wait for a BOS to form, where the price breaks the previous high. Here, after crossing the high, the price needs to retrace to complete its orders. We then prepare to enter the position. As mentioned, there are many demand zones we can use. For example, if the price forms an opposing colored candle, it could be a great entry zone. We mark this area and move to a lower time frame, 15 minutes. On the 15-minute time frame, we wait for the price to return to this zone. Once we see a candlestick pattern, we can enter the position. For example, we can enter with a pin bar or an engulfing pattern. Here, we see two consecutive strong green candles, and we can enter the position after the close of the second candle. We can place the stop loss either behind this entry zone or behind the liquidity zone. Initially, I recommend placing the stop loss in a safer area to minimize risk. As you gain experience, you can optimize your stop loss placement. I'll place the stop loss behind the liquidity zone, and for targets, we can consider the upper liquidity zones or set a target 1.5 to 2 times the stop loss. In this method, since we're combining several factors, the entry point we find is highly optimized, which significantly increases your win rate. Let's look at one more example. The price is in a range. First, we identify the liquidity zones and wait for the price to hunt one of these zones. After reaching this zone, we let the price break the previous high, which happens here. After creating the previous high, the price now needs to retrace, and we look for an entry zone. In this example, there isn't a single colored opposing candle like the previous example, so we can use other demand zones. For instance, I prefer working with order blocks as they create highly attractive zones. After marking this zone on the 1-hour time frame, we move to the 15-minute time frame to optimize the entry point. On the 15-minute time frame, we wait for the price to reach our level, then look for candlestick patterns like pin bars or engulfing patterns. Here, we see a pin bar that allows us to enter the trade. We place the stop loss behind this zone and set the target 2 times the stop loss. This can be the initial target, and for additional targets, we can consider higher liquidity zones. As you can see, this strategy allows us to achieve very attractive risk-to-reward ratios. But remember, practice is key. Although this strategy can hit stop losses occasionally, which is completely normal, the excellent risk-to-reward ratio helps us grow our accounts significantly. I hope you make the most of this video. See you soon.